Hey, what's going on, everybody? Just getting things loaded up right now, and we're going to start in just a minute. So let me get some things going, and then we'll get started. Hope you guys are doing well tonight. So thank you so much for joining me. On this Friday night, Bollinger Bands volume indicators. Hey, how you doing, William? Just gonna give myself a little playlist going. I like to just kind of hang out and listen to some music as I do some of these chats and sessions at the same time. What kind of stuff do you guys like to listen to? Thanks for having use. Really appreciate it. Yeah, you're more than welcome. You know, usually winter time's a little bit slower for me. So a lot of people take holidays. I do a lot of mentoring during the season, but during winter time, it's a lot slower. And, you know, I like hanging out with you smart folks. So it's nice. It definitely gets your brain going. Maybe one day, hang out on one of those Twitch streams for a little while and play chess with you guys or something like that. But, you know, now that I have a little schedule with the kids being back in school, I can find more of a concrete routine. So, and then we'll see as after the new year, I might do a little less of these evening sessions, but I know that the kids are in bed by now. Usually, if I ever cancel a session, it's really because of, you know, the kids might need to be up or I'm just not able to get to it. So anyway, all right, let's kick things off. Good evening, Rich. How you doing? All right, happy Friday to you guys. And let's kind of get started. I'm gonna get started with a nice clean chart. If there's some stocks you want me to take a look at, feel free to mention them. We're gonna go over them in some details, but really we're gonna talk a little bit about technical indicators. And that's my main focus. Keep in mind, none of this stuff that I'm talking about are advice for any trades, any recommendations, buy, sell, anything like that. I might not even know what I'm doing. So just take it with a grain of salt and talk to somebody that knows your personal risk levels. Your account size is going to be different than mine. So always take that into account. All right, let's get started. I'm going to go in. And as you can see, today's market is a little weird. I only had like 2 alerts. Actually, you can't see it because of my head, but here you go. You can see I only had like 2 alerts. So not much action today from a trading perspective. I did throw some trades in, but they were losing trades. So nothing big. Hey, good evening. We got the chat going. Who do we have going on here? We got Mark. Good evening, Mark. Good evening, JL. Ziegler here. Dunny, Rich, and Casimir, and William. So welcome, everybody. And thanks for joining me. So I'm going to get started. All right, kill the timer, show the chat. All right, so today we're going to talk a little bit about technical indicators. And I think it's one of the most misunderstood things in the trading communities, at least from the coaching sessions that I've done over the years. I've probably done a couple, I don't know, maybe pulling into 500 or 1,000 sessions by now. I'd have to check back. I've only started coaching actually 2 years ago. I mean, I've been doing a lot of trading before that, but I've only opened up and done one-on-ones over the last 2 years or so, and mentoring as well. So over those years, I find that so many people put a lot of emphasis and stress right into the indicators. They're always looking for like the magic grail, the holy indicator. And really, when it comes down to indicators, I really like to crawl people back, the people that I work with, on the mentoring side especially, that it's less important. Indicators are a lot less important than managing the trade. Managing the trade, capital management, and sticking to the same thing over and over again is way more important than indicators. Indicators are just a guide, it's a guideline, and there's kind of 2 main things there when it comes to indicators. Let's see if my drawing thing now is going to work. Let's load it up. Zoom it is what I use for drawing. So there's kind of two main things when you look at indicators. There's kind of leading indicators, and then there's lagging. So we've got, it's not working, leading and lagging. So as we check those two types of indicators, the leading indicators are things like volume and price. Those are kind of the trigger. Boom. They happen instantly. The results are instant. You're seeing them happen right away. The lagging indicators are things like moving averages, MACD, stochastics, RSI, Bollinger Bands. They're all lagging. But what you have to recognize is a lot of those indicators, many of those indicators, they stem from price and volume. If you take any indicator, and I'll just kind of go off the cuff here for you guys, just to do some Google searches, and you can do this yourself just in case you were curious. So we'll go into Google, and then what we'll do is we'll pull up, let's just say MACD indicator, okay? And MACD indicator formula. Let's just look up the formula for it. What you'll notice is with a lot of these things, as you start breaking them down, hey, good evening, Ray. What you'll notice is a lot of these come down to the price and volume. So when you start breaking down of like how it's calculated, it's 12 period exponential moving average, and then the 26 period exponential moving average. So they're using the moving average. And where's the moving averages stem from? It's price, right? So this is kind of, again, it's lagging the price. So you have to recognize that these indicators are kind of they're behind. So if you can read the price and you can read the volume, you'll be way ahead. Now, these indicators, though, I will say are a good guide to set kind of alerts. So I'd say if you're just getting started with indicators, forget pretty much everything you've probably heard, unless you're really more experienced. It's more along the lines of keep it super simple. You don't need 5 or 10 indicators. Choose 1 or 2 and stick with them because you're looking for consistency. And that's what you want to see is consistency. How is VWAP, daily or multi-day? Yeah, you could look at VWAP as well. Volume moving average. But again, it's a composite of price and volume, right? So they're all kind of tied together. So again, a lot of it is lagging. VWAP is good kind of for day trading usually a lot of times. So anyway, as we get into some of these things and we start taking a look at just any indicator, I think one of the easiest ones to work with for a lot of people getting started, I'm going to go kind of like easy at the start and just show you some more advanced things later on. And not anything too crazy or too advanced, but I will say that all indicators work. Right? And that might be a bold statement, but a lot of people say what happens is the reason people fail with indicators, they try one indicator and it kind of works once, twice, 3 times, and then it starts failing. But remember, this is a statistical business when you have to look at 100 basis of trades. So sometimes they work, sometimes they don't, but they all work to some degree or level because price can actually do anything. So the indicator is just a guide. But then other times you'll have people go into the next indicator, then it doesn't work. So then they hop around. And this is pretty much most people's trading careers. They go from 1, 2, 3, 4 indicators, and they keep hopping around because it's not working. Their trades aren't working. When in fact, again, remember what I said at the beginning is the management of the trade is actually way more important than actually the indicator. The indicator is there as a guideline. It's like a secondary tool. And if I was to really look at things, let me pull up the drawing tablet here. If I look at actually the indicator, let's hope this works. All right, that works. All right, so again, let's say, again, you could break this down into different levels and areas, but let's just say part of this business is going to be psychology. And I will say a lot of this is psychology. Then you'll have another part that might be money management or risk management. And then you'll have another as far as maybe, let's just say different strategies and diversification, hedging, timing, and part luck. And then there's some other stuff that goes along with it, but let me go into the indicator part. You're gonna have like a tiny sliver where it's the indicators. Okay, so we're talking about a little segment here when we're talking about indicators, and people always think it's like kind of like, I need the indicator, but I'll show you like a very simple thing that I show a lot of my mentoring clients that I work with. So we can start out with some of the most simplest things going on, and that's what I like to do is just moving averages, as simple as it is. And you can start with whatever number you want, whatever you feel comfortable with, and I'll show you why in a second. So I'm going to edit this one. This is the 10. I'm going to make it bolder and thicker so you could see it, just as an example. Okay, so here's the way you use this indicator. We're going to delete all the drawings. So as far as trading goes, here's how you can do it. Let's just back it up way back here. All right, because remember, we talked about trade management being way more important. So we could go in and say, okay, anytime this market or this stock is under the indicator, so it's below, I'm going to add one contract or one vertical or one call or buy 10 shares, whatever your reason is. So let's just say 1 or 2 contracts or so. Is support and resistance more important than the indicator? I would say so, William. So yeah, when we look at support and resistance, I would say, yeah, it's more critical. But let's just look at how we can use an indicator as a basic trading guideline, because again, it comes down to how you manage and work the trades. That's really the more important part. Support and resistance is just a tool in the same way that this indicator is just a tool. So it's kind of like what you'll have is, if we look at all our tools and we look at our portfolio, what people don't get, and I'm just talking like bigger portfolios for sure. I've talked about it before. Smaller portfolios, not as big of a deal, but I might do verticals. And this might be like, let's say, $50,000 of my account. I might invest and have actual ETFs, and I'm just going to make it even. Let's just say this is $50,000 in my account. I'm going to say I'll put 50 grand into iron condors. Okay, I'll do butterflies. Okay, in a different way, like these could be like bullish. So all these, and I could have more of these, like everything that you learn, like you could have now, like where does this kind of fit in now? So now what you could say is, okay, I have my moving average trades, which is another thing. Okay, and all these together create my final profit and loss. And it's in the same way that you could also have support and resistance trades. And they, in the end, create your final total. So if you can spread your risk out, then that's really what you're looking for. And like a lot of people, what they try and do is they do one thing, and that's fine, that's good as a starting point. Do one thing first, but then what you could do is build on it as your risk, your account size grows, because you need to when your account size grows. Ray asks, do you recommend to start with low moving average and not 50? It's going to depend. I'm going to go over that here in just a second. So here's a little test you can do. Everybody asks what's better, right? Like, is VWAP better? Is moving average better? Is this better? And I'll say none of them are better. It's what's better for you. That's in the end what comes down to, because you got to make it fit, right? It's kind of like my schedule. It's got to fit with your schedule to be able to attend live. It's kind of like, hey, my kids are asleep, so I'm able to attend. Or my trading, right? If I got my kids like constantly nagging on me over here on the side throughout the day, I might not be able to be a day trader now. That's just the fact of life. Now I have to be more swing trader, longer term investor, and that kind of stuff. That's just part of, raising kids between 1 and 4. We'll see if it's when they get to 6, 7, 8 years old, if that's still going to be the case. I might be able to be more active like I was 5 years or 7 years ago. But point is now what's going on is right here. Let's just look at this example as a basic rule. Okay, so let's say anytime this goes down, and I'm going to just use simple numbers. Anytime it's under, okay, anytime it's under the moving average, I will go ahead and add 1 share, okay? So here it is, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You just do 1 trade a day, right? 1 trade a day. Okay, right here, you just add 1. Anytime it's above it, I let it run. Okay, so what you're doing is you're just kind of using it as a guideline. So what you're trying to do is look at a longer term. Again, depends on what your length and time of hold. So if I wasn't doing it in this range, okay, I would be adding down here. So that's the first part. So where do we enter? What's our entry criteria? In this case, it's going to be when I go ahead and anytime it's under it. That could be one type of entry criteria. It could be anytime they're under, it's there. Another type of entry criteria could be Anytime it's over or breaking it above. So anytime it's above, I keep adding one contract, okay? And that could be another trigger point. So you have to look at, there's a trigger and a condition. People get those mixed up, okay? So when you have a trigger is to do something. A condition is something that people state that they say, hey, the market's oversold, so I'm going to be bearish. But that's not a trigger, that's a condition. If the market's oversold, it doesn't mean it's a trigger for you to do something. Or the market's overbought, the market's toppy, the market's way too high, I shouldn't be buying anything. But that's not necessarily a trigger, that's just a condition, right? So understand there's a big difference between condition. Condition is just a, kind of like a symptom. A trigger is actually to do something. When the fever is 103, you need to do something. So there's a big difference, okay? All right, let's see. Okay, so here what we can do, use daily for swing. Yeah, so we're talking about swing, but this can apply to other things. So as we get into it, you can see how it's gonna work here in a second. So as a simple point, understanding how they work, because if you understand this basic concept, you'll understand it for RSI, MACD, stochastics, you name it. You pick your indicator, whatever floats your boat, and you can kind of go from there. You just learn how you want to use that indicator and kind of the preference behind it, right? So as we take a look at these, what you could do is, let's say this breaks above, you get in, okay? You can make it as simple as that. You get in right there. Now, normally I wouldn't say get in everything at once just because it's a little bit more risky. I say spread out your cash, especially the people I work with usually are dealing with larger sums of money. So you're spreading out your cash across different days, across different types of expirations, across different vehicles. But here, let's just say you get into something as simple as that. The minute it breaks under it, you're out. So this right there is a failing trade. The minute it breaks back above it, okay, you get back in it. So again, here it is, back above it, you get back in it, and as it starts rolling over or crossing over or getting a little too high, too far stretched, you could take off half, right? So as it starts its grind a few days into it or so, and you kind of get the idea of how long that range is based on your past, okay? So based on the past, you get an idea. So after a little bit, let's say you got in 100 shares, you could go out and take off like 50 somewhere over here. Like, doesn't matter exactly where. You take off 50. The minute it crosses under, you are out. That's a simple system and strategy. Very super simple, okay? So now what do? We could do this again. So, okay, this is under. I don't do anything. Okay, crossed over here, but not on the daily, right? Not on the full day. So let's say, okay, again, it crossed over. I'm in, I'm holding. How far am I going to hold? Right? Probably right there. It didn't cross under, but again, depending on your rules, right here, you are basically out. That's it. Done. Okay, so there's your next trade. Okay, next trade after that. Okay, it's crossing. Boom. You got in right here. Let it ride. Probably out in one of these areas again. Okay, got back in it, back above it. Okay, letting it ride. Okay, back and out. And in between those, you're taking profits off. So that's a simple indicator. So how do you tweak this for you? Okay, because some people like to trade more active, right? So if you're trading more active, you could be the daily. If you're more or less active, you could use like the weekly. You could use like 195. You could use 130 minute. So everybody's a little different. Choose a time frame that works for you and then tweak the moving average. So now I could say, okay, if you want less trades, just bump up the moving average, okay? So if you want like less in and out and stay in the trade longer, like look at a 30, look at a 32. Don't look at what everybody else is looking at. Find yours. At below, Ray asks, at below you only enter after green, right? You get to decide that, Ray. Look, I'm just throwing a concept, a thinking point for you. So you could say when it clears the full daily bar, okay, you could then combine it with volume as we're going to get into it. You could add a second indicator on top of it. But again, super simple, right? Again, money management beats way anything over these indicators. Have the right money management, have the right psychology to doing things over and over again. What's the number one failure for not losing weight? It's consistency. People can't do the same thing every day, right? It's not like it's a secret. There's no secret magic pill. It's, eat right, be healthy, exercise. I mean, that's kind of like 80% of it, right? But most people can't stick with it. It's the habits. So here, if we set up a trigger point, what are we doing? And if we look at, okay, what time frame do we want? If I want the daily and I want like a 40-day, that's like the type of signals I want. So now I'm in it right here. I'm in it. And then right here, I'm out. So that trade didn't do anything. And then again, as we start going in, where would I get back in it? Right here, when it crossed it, okay? And then I'm out again, so that trade failed again. Basically break even. Super simple. I hope this makes sense, right? Getting back in it or back in it right here. It's kind of held, probably get out here, but again, you're getting back in it, and then finally you're getting a run. So you can see there's like 3 or 4 trades that may or may not work out or break even, and then after that, you're starting to see some positive sign. So that's kind of what we're looking at. Now, how do I now combine or stack another thing on here, right? Because remember, when we're looking for things to line up, right, when you take the trade, so when is it go time, right? So I got number 1, let's just say a bull market. Do I have it? So this could be looking at like the SPY or SPX. It could be looking at the Russell. It could be looking at like a lot of things, like underneath are the institutions buying. So you're looking at the overall market. So if that's a go, that's like one thing in your checklist. Then the second thing is the stocks you're looking at healthy. Okay. And again, there could be 3 or 4 or 5, 7 other things. Then the next thing it could be, is your trigger happening? Is it going? Then you could add a second trigger, trigger number 2. So this could be like volume. So this could be also, this is your moving average. So now you've got like 4 points. So if you've got 3 of these out of 4, you might be like, hey, I'm at a good point and I'll take the trade. If you got 4 out of 4, it could be boom, I'm flying. Hey Ray, what are you confused about? Be a little more specific, please. So anyway, you're looking at kind of like 4 main things to pull the trigger. I thought you said enter below moving average and exit when it goes below. You could do a lot of things, Ray. Look, you could go when you could enter at both points. You could enter when stocks are under and add to the position, meaning averaging down, okay? Or you could also do it the other way when it crosses above. You could do both, okay? Hey, George, welcome. So, yeah, so you could do both. You don't have to do it. There's no specific way that's one way is better than the other. It's more of a question of, do you like to be a value buyer and buy it when it's kind of low or way extended from the moving average here? Or do you like it when it breaks above the moving average? So you could do both, Ray. You don't have to go in and do one or the other. You could do both. Either one will work, but choose one, okay? So some people like that I know, they like to buy on dips, right? The stock goes down, like anytime it's down, they'll buy a bunch. And then once it starts grinding up, and it gets too far extended, they'll start peeling shares off. Then again, once it gets way below, wherever over here, they'll start adding, right? And then once it gets too far above, they'll start taking off. Other people, they like to do it more conservative play is breaking above and let it grind until it breaks below. Again, using the trigger. The biggest thing I enter on is break and retest. Is there a specific indicator I would use with that idea? Okay, so if it's a break and retest, it's kind of like looking at support and resistance. So you could look at it, but there's no specific indicator. You're using your own kind of support and resistance levels because you're using price. Price is your indicator. Price and volume. So you're looking at volume. So the question is do we have more volume coming into it? Okay, and is the support being held up right there? If you're looking at those, that's what you're looking for. And then you're managing your capital based on the price, William. So that's the way I would personally look at it. Is the indicator there, in your case, is the analysis of the price level, okay? I'm looking at also these other indicators like moving averages and so on that you can also use, but you can simply use these as well. Those are your own indicators, support and resistance. Is there any indicator which says it's almost bottom? There's no such thing as an almost bottom. What they will do is tell you if it's overbought or oversold. So anyways, I hope this makes sense. We're going to get into some of these other ones, Ray, in just a second. But look, when you have things like oversold right here, almost bottom, you could say, is it bottom for what? Bottom for the week? Bottom for the day, bottom for the month, bottom for the year. Again, everybody's time frame is different, and that's why you might adjust this time frame. Okay, so here is another indicator. Let's step into a Keltner channel. These Keltner channels are a little bit different, so let me thicken them up a little bit for you guys. And what they do is they look at kind of the range. Okay, so they're looking at the range of average true range. So it's a little different than Bollinger Bands. Okay, so we're looking at how far that range on that stock is kind of moving or going. Okay, when it gets to 3 times the range, that's pretty serious. That's where you get that overbought, or the bottom, you could say. It's not necessarily the bottom, again, but it gives you, again, another idea. So here, a little more difficult to see because these are a little, you could just have one Keltner channel, obviously. And we'll do bars here. Not bars, candlesticks here. Okay, so what you can see here is that when we get down, so if you don't know what this is basically looking at the range of movement. So they're all equal distance, by the way. And what it's looking at is kind of the distance of range. Are we 2 times the range? And you can see these are like kind of like swim lanes. So I'm swimming in this lane, and the minute we get into this next swim lane, are we swimming in that lane? And remember that stock prices can do one of 2 things. They can break away or they can pull back to the average, and the average is our yellow line there. So when we look at this, when we hit this 2 times, like look in the past, we hit this Keltner 20, the second swim lane, we hit the upper part and we're grinding. When we pull back and we get back into that swim lane again, we know we're probably overbought. Okay, so in the same case, like down here below, what you can see is we're kind of near that bottom level, so you get that snapback. So what happens usually is when you start moving forward, you get that same swim lane again, you're hitting that bottom and you get that snap. So you can see on the bottom part, we were using the gray swim lane. On the top part, we were using the orange swim lane. So that kind of gives you kind of an overbought, oversold kind of idea. Is the RSI the most basic for oversold and overbought? RSI is relative strength. It's the strength. It's not necessarily overbought, oversold. It is to some level, but it's a little different than this. I would say a lot of people like RSI because it's a little different. It kind of works under your chart. It's not as confusing, but I like working directly off of price because remember, price is the key. Everything works off of the price. So I'm looking at how far extended is the price. So we'll get into RSI here in a second, and you can pull up these things on Google. So if you look at Keltner channel indicators here, you can always look them up and what they do, and you just have to choose one. Again, do I use all 3 or 4 or 5 of these? No, I typically use moving averages, Keltner channels, Bollinger Bands at times. Sometimes I use RSI, but not as often because I can usually see the strength from the volume for me personally. So when you look at kind of Keltner channels, you can see right here, let's see if they got the formula here. Okay, so here it is. What you can see is that you've got the middle line is the EMA. So again, exponential moving average. And then we have the plus 2 times ATR or minus 2 times ATR. So those are the upper and lower bands. And what I've done is just done a few of these or put on a few of these. So really most Keltner channels here would be looking like this. Let's just go like this. So it's different from a Bollinger Band, but it probably look kind of like this. How do you get 3 different bands on Keltner channels? You just do one, then you add a second one, then you add a third one. So the way that I do it is like one is at a period of multiplier of 1, right? So when you look at the formula, they look at the EMA. And it's basically the standard deviation range. I'm doing kind of multiple ranges. So here I've got ATR multiplier of 1, okay? Then I have a different one here that's a multiplier of 2. So it's kind of like a 2 sigma move, right? Or a 2 not sigma move, but 2 ATR move, average true range move. For those of you that don't know ATR, it's the range of the move. So average true range right here is kind of the bar distance, right? The range of the bars from the top to the bottom. So when we're looking at that, we can go in and do even a third one. So there's the upper one. So sometimes you'll hit the upper one. There's some that are tighter. If you're using a tighter one, you could put that tighter one in. And again, this is where you could see, hey, are we overbought? And you can see like right here, yeah, we're kind of away from the channel. So you probably know it's going to pull back. And this is where for some people, support and resistance, there's your resistance. It broke above it, but then quickly came back because, you know, you were trending at that upper range for a little while. So you can kind of use it as a guide. And you can see kind of how it hugs those channels, right? It's hugging those, and you can say, hey, it's a little overextended, but remember, that's a condition, not a trigger, okay? So they can get further right there. There's the 3 times multiplier, 3 times the range, but again, then you get that snapback. Again, getting close, snapback. getting close to a little bit of a pullback. So again, it means it's just overextended. So if you're buying on dips, if you're the type of person that likes to buy on dips, you know, something right here it is coming in, it's going to extend. And you can see this on just about anything, like right here coming in. Are we up there? No, not yet, not recently, not on the daily, but you could change it to like a 65-minute if you like doing like more shorter term, or 15-minute. Again, from a shorter term perspective, we're kind of extended, so we might get a pullback a little bit, but then you also have to look at a longer time frame too. So anyway, so you can use like Keltner channels as well to get some extensions and get some ranges. That's kind of another way. Then you also have like, here's another one that's Keltner channels, but this is more institutional Keltner channels that I use, where like when they get to these levels, the lower level, that's when the institutions really start buying in. It's kind of like the 200-day moving average. So you could get like these are bigger moves. So it's a 10 ATR multiplier. Let's go into Bollinger Bands. It's a little something more people are comfortable with. So I typically show this Bollinger Band, and Bollinger Bands is just, what it's looking at is a little bit different. It's looking for, they squeeze, right? They compress. Rather than the ATR channels are more even, these are more of a squeeze. And when you're looking at these, what they'll do is expand as the volatility starts to increase. Can I pull an apple? Yeah, absolutely. So as I start looking at this, you can see they're going way above the Bollinger Bands, and it's going, but this condition can last for a while, right? Because if you've got volume and price moving, these things can still grind on that upper end for a while. Okay, so as we start taking a look at this, they squeeze, and usually after that squeeze, it pops. Okay, so you'll notice that a lot in Bollinger Bands. You got to squeeze, and then he tries to move one way or the other. And once they get expanded, you know, you're either overbought or oversold on one way or the other. If you're on the downside, you're oversold. If you're on the upside, you're overbought. But remember, those things can last for a couple weeks, no problem. Okay, so as we check this out with Bollinger Bands, and I'll show you the one I kind of look at. Let's see, it's, where is it? This one right here. You can kind of look at it. It's the same concept of the average true range. You have multiple Bollinger Bands. I usually don't show it on videos when I'm making videos too often, but as far as this is an indicator session, Bollinger Bands typically hug a 2 standard deviation move, which is, if you don't know standard deviation, you got like a 1 standard deviation, 2 standard deviation. So it's like 68, 95, and 99% kind of thing. So this one's at about 95%. So 95% of the variables will be contained if you're looking at this blue line. But I also have some other ones where it's like a 1.5 standard deviation and a 2.5, which is lighter because I don't want to see it as often, but it's like 99% of that stuff should be kind of contained in there. So normally when I'm showing this, I just show the 2 standard. This is the most common. So as we get overextended, you can kind of see, hey, this is a little extended, way above it even, and that's where you get a little pullback. It'll hug it, you know, a little extended, and it'll hug. It doesn't mean the trend can't go higher, because the trend is still there. Don't think of it as being bearish, because this is what people do wrong, is they say, hey, oh man, it's beyond the Bollinger Bands, and then I'm gonna go bearish. It's like, no, it's not a trigger. It's a condition. We are overbought, but it's not a trigger to go short, right? It's not a trigger to go short. It's more of a trigger of like, hey, I probably wouldn't be buying up here, but for a pullback, and now that we're pulling back to the average or close to it, you might start nibbling a little. Again, you get extended, you pull back, and then boom, the trend overall is still there. So bigger picture, right? Where's the bigger picture? The bigger picture here, the trend is still there. Okay, so as I look at the trend, got a little lag there. So as I look at the trend, we're still moving in the upside, but are we pulling back? And when we do, that's where the adding point is. So Bollinger Bands, they kind of look at the expansion of range. And if you want to look up Bollinger Bands, again, just to do some Googling with you, Bollinger Bands. John Bollinger invented it, by the way, in case you were curious. You don't have to know the full formula, but here's the, what do they do? Moving average, upper Bollinger Bands, typical price. Again, look, it comes off of price. They smooth it, standard deviation, and it kind of gives you that overbought, oversold kind of condition. So again, overbought, oversold, though, does not mean you go short. And this is where a lot of people make a mistake, because do I go short here? No. Do I go short here? No. Do I go short here? No. Would I buy it up here? Probably not. I'd probably rather sell puts at like 160 to see if I could pick it up at 160. but I wouldn't go short here specifically. So there's kind of the big difference. And the same thing when you get on the lower levels, like any lower levels. So if you're like interested in buying dips, right? If you're a buy the dip person, it's all catered to different people, right? So if you're a buy the dip person versus you buy on strength, if you're a buy the dipper, you could buy it when it's overextended here, 1, 2, 3 times, right? Just split up your stuff. And again, overextended kind of, you could buy the dip, and then eventually you get compression and so on. Again, if I find another one right here, if I'm outside the range, I buy the dip, and then I'm waiting for it to move. Do you also use percent Bollinger B with Bollinger Bands? You don't have to. I like to keep my stuff super simple. I would rather just have a trigger where, hey, are we outside the Bollinger Bands? And this is when the indicator use actually makes sense. And this is when to use the indicators. Is, for example, now you can set an alert in a lot of this software where the Bollinger Band is exiting a channel. Okay, exiting the Bollinger Band lower or upper channel. And that's where the indicators are nice. That's why I like to use certain indicators for alert purposes, because what you'll notice here for me, I've got, I'll have to pull this over a little bit because of my face. If I look at the alerts, like everything's based on the alerts. I don't really watch stocks too much throughout the day. Like I'll do the trades, but I can't really spend time. I got alerts on like probably 50 stocks or 50 different alerts. And I've got, okay, in the last 2 days, I got some alerts. But if I look at the last like 30 days, look at all these alerts that got triggered. So I've got different stuff that's got triggered. And then I've got a lot of stuff here that's kind of waiting. So I've got a lot of stuff waiting for different alerts. And it's like once I see that alert, it'll tell me like, hey, this one's crossing down a certain trend that I set, or it might be, let's say 2 days. This one might be a moving average, like the 8-day moving average. So the point of the indicators is really nice for alert purposes, because you don't have the mental capacity to really look at a lot of stocks, and that just saves you a lot of time. So as I'm doing scans, like I'll do this kind of scans, and as I'm looking at, let's say here, let's just move here to Chewy's, and we can go in and I can add a simple moving average here. Let's just go back to a moving average, and we will go like this. So the minute this crosses like the 10-day moving average back up, Chewy crosses back up, I could set an alert trigger for me to maybe look at it again. Okay, rather than go long. Doesn't mean I go long. My trigger could be different than my alert. So my alert might actually be just the moving average, but my trigger to actually enter the trade might be different. I might have to go through a lot of these checklists for me to actually enter the trade. This would be like maybe 5 things, 10 things to do before I actually say it's go time, right? That's the big difference. Before it's go time, you might say, I have a formula. And if those things don't line up, if I only have, let's say if I have 2 out of 5 going, again, this isn't my full list, but each one is going to have its own formula or system, right? But if I have 2 out of 5, I might trade 10 shares, let's just say as an example. If I have 3 out of 5, I might trade, let's just multiply it times 2, let's say 20 shares. If I have 4 out of 5, I might say I'll trade 30 shares, and 5 out of 5, you might say you take a bigger position, like 50 shares. So that's how you kind of look at it, is that, okay, I've got my alert. Now, when do I go in and actually pull the triggers? Now I have a criteria checklist. That's the smarter approach. Now, you could add a lot of different indicators on there. There's so many. So as you start looking at these, let's go back to Apple since you guys like that. There's a lot of criteria that you could do when you start looking at alerts or conditions or writing your own formulas. There's like a lot of stuff you could do. But let's go in and just look at, there's so many different stuff from indicators, and I mean just so many different stuff that you could go in and put in Ikimochi, envelope channel. I mean, some of this stuff is specific to different trading platforms. Moving average is the simplest. There's kind of like the VWAP that we were talking about for a minute, but then there's the ADX. I mean, you know, I don't use a lot of stuff here, but let's go into one of the more popular ones, like the, let's take a look at RSI here. We'll just take a look at, let me see if I type it in. Let's see if it's got it on here. Relative Might not even, there it is, relative strength index. And we will put it on, I don't need to scale with, let's see, it's by itself. No, it's not there because I got to get rid of that. Okay, because I haven't changed my charts that often. I usually just leave them. Scale RSI by itself. No. Add plot. Is it the other one? RSI scale with Apple. I think I gotta move it down because there's a data plot source, main chart, other indicator panel. It's not letting me do it because I always have all the. Let's go to Wilder's scale by itself. No, it's let me pull up the Williams AD. That one doing it. 1, 2, 3. Got this one. I got this Ichimochi cloud, and I got this one. So yeah, because once I set them up, I usually don't change them too often. It's more along the lines of, I'll try it one more time here. Let's see if I could get rid of it from here and move it over. Because main chart, we've got data source. I could pull it up on the Thinkorswim here. Other indicator. Not going to be on that. It's not doing it. Okay, I have to check it out on. Let me just pull it up on the other screen here. On this one. Okay. Studies, quick studies, all studies. I can't, don't let my mouse go there because I have it larger. Okay, let's see if I can just edit and add one in. There we go. RSI, Wilder's. Okay, so there we go. And then I don't need the account net lick. By the way, if you were curious, the account net lick is a nice thing to kind of see your performance as well. Okay, so RSI, which you could do, and I know a lot of people use the trading view. I just don't like trading view as much for charts because I like the TC2000 for breaking things apart. It's just my main platform. But with the RSI, what you could see is just the strength of things. So as you look at Apple, you could see just the strength of the move, and it combines like, you know, the volume, the price action, and multiple things. And what you could do is use a lot of these indicators. This is kind of a oscillator indicator. So when it gets above there versus below there, you're kind of watching these things. And you can also use these, you can put support and resistance on these. I don't know if you guys knew that. So even though over here, you could say, hey, there's some resistance. What it's saying is it's kind of like the stock is strong. Right? Over here, the stock is weak, but usually this weakness point, I don't take it too much into kind of like, don't dismiss it, because what it's usually doing is it's building strength, right? It's isolating. The buyers are kind of waiting. And then what happens is it's starting to pick up speed. And this is where the people that like support and resistance, what you'll notice is it starts picking up speed because the strength is picking up. And why is the strength picking up? Because the volume is picking up. So again, where does this stem from? Price and volume. So they really come from these levels. And then what you'll notice is, again, we come back to retest right here. So we come back. So you can see we're creating a higher high on the RSI, which is typically good. And then again, you break out. But again, just because you pull back doesn't mean the stock is now done. And this is where a lot of people misread things. And it's part of the psychology game too. It's like if you took a too large of a position here at some point, if there was too large of a position, you probably got stopped out by one of these bars. And that's painful, right? I know I've been there. I've done it multiple times. I still do it sometimes. And then again, you get the strength coming back in there, but you take these now into account. What did the Bollinger Bands tell you? It's a little, you know, overbought. It could have a 1 or 2 day pullback, so prepare for it. You might want to trim a little. So you're starting to put these 2-3 things together and make a little story. And I find if you make your own little story with the technical analysis, it actually works out a lot better. If you want to look up RSI formula and just kind of where it stems from and just how it works, again, a lot of people, they're kind of looking at, here's the RSI, Investopedia. You can see the formula, RSI step 1. So what it's doing is it's kind of looking at just the overall movements over the periods. Previous average gain times 13, current gain, average previous loss. So calculation of RSI, which you're looking at is overbought and oversold. They use the 30. You could create your own formula. If the stock is more volatile, you could change it to, I've seen it 80 and 20. So I've seen it 90 and 10 for more volatile stocks. So you could tweak it based on what you want. It's just where the signal lies. And this is where now you can set a signal for when it crosses above like a 70 or an 80 or that kind of thing. Like it gives you an idea when it's like down here, like let's say it's under that 30, there's a trigger maybe, it's kind of acting and behaving weak. William says the higher highs and higher lows is how you do the divergence off the RSI, correct? Yeah, I mean, there's different ways to use these indicators, and I'll say multiple, just like we showed you at the beginning, the moving average. You could buy it when it's breaking below and then selling as it breaks above, or buying as it breaks and then keep selling until it breaks below. With these indicators, there's probably like 10 different ways to use them. You could put a moving average on top of these indicators. So what you can do is also create a moving average, which is, I used to do that on that other platform, that when it kind of, as long as it kind of stayed above a certain moving average, then I'd be in the trade, or it would trigger me to buy or sell. But again, I found that was even more and more complicated. The more I dug deeper and traded more often, I actually started simplifying things. I don't really use RSI that much anymore. I just use simple moving average, trend line, support, resistance, and price and volume. Price and volume to me is everything, because I could figure out, I don't even have moving average on this one, but I could give you an idea of how and what that moving average is going to be like without even kind of putting it on there. Because, you know, we're kind of picking up some speed, and then, you know, it's lagging here because probably getting more extended and whatever. So you're kind of looking at it, depending on the time period, of course. Is there anything it tells you how long it will stay in overbought area? No, Ray. Things can stay overbought or oversold probably longer than you think it can. That's basically the thing. I will give you some insight on just the probability of range though, and we use this on the option side quite a bit, but you can use it for stocks. So here's kind of a cool little trick. So let's say you plan to be in the trade 28 days, and you can only do this like early on, right? So if I'm getting into the trade now, I want to take note of these numbers. And you might be wondering why. These numbers over here are your expected moves at one standard deviation, okay? So we're going to get into it in a second, but let's say I'm expecting a move of about $15 in the next 35 days, and that could be plus or minus. So the way you can kind of calculate it is every week on Monday, you could take a screenshot of this and say, okay, if you like doing this, obviously. If you don't, then obviously don't do this, but you could use a different method. All it is just we're trying to find a method that works for you. So what you could do is take a screenshot of this and say, okay, I'm looking for a 15-point move, up or down. Current price is about 180. I'm looking for a 15-point move. So how do I calculate this? So if the price is 180, I'm looking for a plus or minus 15-point move. So that'll put me at 195, okay, or 165. Okay, so the stock can either go 195, hopefully my math is right, and 165. So we can go to either direction. Now that is at one sigma move, one standard deviation. Okay, so those that don't know standard deviation, one standard deviation, here we go. And then we go 95%, let's just say, and 98. Okay, so 98% covers like quite a lot. And again, there's points in there. But what we're doing here and kind of looking at is now, as I check this out, see, that doesn't move it. There we go. Okay, so what I'm looking at now is, remember, this 15 points is one standard deviation. So that's at 68. So one standard deviation is 15 points. Two standard deviations actually 30, and a 3 standard deviation move is now 15 times 3, that'll be at 45. So I have to actually budget for a full extension in about 30 days. I have to budget for about a 45-point move. So this stock, actually, that's one standard deviation. So now as we're looking at it, I have to look at it at a 3 standard deviation move. So if we're at what price are we at? 180. And then we got 15, 15, 30, 30, and 45 points. So I have to actually budget for all of these movements. So this is 195. It can actually just go way up there. I can go 30 points more, so that'll put me at 210. And 45 points is, what are we at? 225. So I can go there, or I can go into the other range downwards. So 180, 170, 160, 150, and 135. Or the other price point we looked at was 165, right? So I have to look at these ranges. So if I'm looking at a full extension, that full extension can go down to actually 135 or a 225 in 30 days to set up for iron condors. Yeah, William, this is exactly what you look at for iron condors, is you're looking at what's your ranges and extensions. You're looking at, the probabilities, because anytime like people put on a trade, they don't look at these kind of numbers. What's the potential? So if I go into a stock at 180, I have to be prepared. Like most of the time, like 68% of the time here, brain's starting to slow down a little. 68% of the time here, we're going to be fine. It's a 15-point move, okay? But a lot of times you might need to be able to cover a 30-point move. So are you able to handle 180 points or 180 stock minus 30? So that'll actually only put you at 180, 70, 60, 50, at 150. So if your stock goes down to 150 in 30 days, can you handle it? So that's what a lot of people just, hey, oh my God, I freak out. If you can't handle the 150, you're probably trading too big. Because what a lot of day traders do, a lot of the YouTube videos people send me from the coaching sessions is they say, take a look at this video, this guy made whatever X amount of dollars. And it's like, okay, yeah, great. But the problem is a lot of times people can't handle the sustainability of the move. And when you can't handle the sustainability of the move, it means you're trading too large, because what happens, you get stopped out because you were too big. And if you find you're getting stopped out too often, you're probably trading too big for what you're either capable of or what you're comfortable with, or just your normal flow. And what you want to do is get into the flow. Does that make sense? Okay. Let's see. Any other indicators you want to kind of cover? I got a couple others I wouldn't mind taking a look at. Let me see if I can grab this one see if I can get it to work. I wonder why this one wasn't working before. I think I wasn't clicking the right button on the plots here. Let me see on Wilder's scale with Apple. I don't know why it's not adding. Remove this. There. Move to pane. There it is. Okay. Kind of in that area. Move pane. Okay. I'm getting back into this. There we go. So now I can probably move Wilder's insert here. There it is. So that's how I do it. Just needed a little time to kind of rethink it. Fibonacci. Yeah, Fibonacci is good. I really like Fibonacci. It's fantastic. But again, it stems from price, right? That's the amazing part about Fibonacci. I really love it, Rich. It's a good indicator to give you what's the potential, what's the possibility, and where can you start maybe nibbling, or where should you kind of take profits into strength. Can you look at Snow and ARKK? Yeah. Let's see if we can look at Snow and ARK. And I don't really need this RSI. I just was curious how to get it back. I just knew it was probably some brain thing that wasn't working at that moment. Okay, so here's the cool part about Snow, in case you guys were curious about fib levels, since we were doing Snow and ARK. Let's just start with Snow. I think I covered it the other day. But here's your range. So Fibonacci, in order to understand Fibonacci, and we'll be doing like a huge swing trading course probably after January. So just make sure you stay up to date and make sure you subscribe to the newsletter. If you are not part of that, just go to our website and kind of sign up to the newsletter or pick up a freebie, and that way you can get notified. So we'll be doing like probably a 10-hour technical analysis thing, really all about this. But here is the thing you're looking at. When you're looking at Fibonacci levels, you're looking at kind of the upper level where the swing point is. And the swing point is a change in direction. Okay, so a change in direction here is we're starting this change. So let's pretend I am in this trade here. Okay, and now I'm holding the trade. So again, don't worry about profit taking, capital management right now. We're just talking about Fibonacci levels. So it's starting to pull back, and I say, hey, I'm going to hold it, whatever, no problem. The question is like, where do I add or that kind of thing. So again, not trying to time it perfectly. I'm just trying to explain the Fibonacci sequence here. So once this starts its pullback, okay, I'm like, oh man, crap, it's going down. So what do I do? Okay, well, it's going to keep going, keep going. Now it starts making its move up. Okay, so it starts making its move up. So how do I now say, okay, if this is the next move up, the leg, this Fibonacci sequence is a sequence, right? It's a flow. So when you look at the flow, you're creating a wave pattern. And when we look at a wave pattern, I'm starting to look at, okay, if I take the highs to the lows here, I can now see what is the potential that that stock gets into this level or this level. And I will say most of the time, at least 50%. That stock can retrace 50% and then continue the flow. Right? That 50% is basically people taking profits. It's normal psychological levels. That's what it is. Technical analysis, it's not rocket science. It's not foolproof. It's basically human behavior. And when we look at human behavior and capital on the line, we're just basing it based on statistics. Now, could it get into 61.8? Yeah, absolutely. But I'm looking at, okay, if I want to go short on this and I say, okay, this is starting to go short, and I mean, hey, I'm going to go short temporarily so I could learn where can I hedge my position for later to be able to go long. Okay, so let's just say you're long. Okay, you're long here, long here, long here. All of a sudden, crap, this is selling off. It's probably going to do another sell-off soon. I just don't know when. This is what Fibonacci may help me. So I'm going to go short temporarily, shorter term, short, longer term, I'm a long investor. So when do I do that? I probably would start nibbling around the 38.2 or the 50%. Right? Maybe 61.8%. So as this starts grinding up, watch what's going to happen with this. It gets actually into the 61.8 and got into the 50. The 50 is kind of there, but 61.8, look at that, how perfect it gets into it. And then it starts rolling over. Okay? And this is where the Fibonacci is phenomenal to making it work. And then you basically draw a trend line here, or, you know, you start nibbling around that 50%. Right around that 50%, you start, you know, starting to short or hedging your position, trimming it for a little bit. And then after that sequence is complete, which is A to B right here, and then B to C is here, and then C to D. So there's the move. This should be about the same right there, close enough. And then you can start nibbling to buy in, get back in for your longer investment. So it helps you kind of average in. So there's a simple like Fibonacci movement sequence there. Okay, so you could do this on a lot of time frames. I showed you a clean one. If you find yourself struggling with trying to find where's the Fibonacci level, you're probably doing it too short of a time frame. Like this is 195, but you could do it on the daily. But if you're trying to find the Fibonacci sequence area, just move on. If you can't find it within like a couple seconds, just move on. For some people, it may take you a few minutes at the beginning if you're new to it. So it may take you like 3 to 5 minutes to kind of like get the practice in. But later on, once you get better on it, like let's say if I just can't find it, I just move on. So because then the Fibonacci sequence then is irregular, the pattern might be irregular, the flow is not there. And it just by happenstance may happen. Not everything has a clean pattern or a clean chart or that kind of thing. So anyway, hope that kind of helps. But let's take a look at ARC here, and let's see if we've got another one as well. Okay, so let's see, Fibonacci. Can you look at Snow and ARKK? Okay, so here is ARC. So as I look at this one, okay, so I could look at this Fibonacci sequence in a couple different ways. Okay, so you could look at it from a shorter duration. I could look at it from the next move up or down. So I could say, okay, well, let me see where the next movement is. If it's this one here, I'm looking at it like this. Where's that movement? And you can see it got above 61.8, but kind of in that range, okay? So you go from the lows to the highs, or the highs to the lows, and you see where it is. I'm gonna go to about 130 minutes so you can kind of see it and line it up a little better, perfectly, or closer, okay? And you can get an idea. It did break above it a little bit, but now you're looking for the next leg. Eventually, when things get too far oversold, it may start actually coming in and rounding off this, and then the Fibonacci's won't play as big of a role. Okay, so if you're thinking Fibonacci is what I'm saying. Like if we're looking at fib levels, like here is one that's kind of interesting because the B to C here is sideways. So here's our kind of sideways pattern, okay? And what we're looking at here is, again, I could take this move. Here's the little one, for example, a little fib level. So what you can see here is we got into 38.2 and then we rolled over. Now what I can do is also take the longer one once we get going. And right here, we get into almost 50%. And then as we follow through, there's my retracement to about that level. Okay. Again, it's just a guide. It's a guide of how much lower can it go. It doesn't mean an ABCD pattern will happen, but as this starts popping, I know that it can probably pop about 50% or so. How do you draw from high to low or low to high? This software is TC2000. You can check my resources page. I mean, you just take a fib level, you just click the high, go to the low, and it'll draw it for you. If you're using TradingView, let me pull it up. I think I have a subscription to TradingView too. Like I probably tried every tool out there, TrendSpider, just a bunch of them out there. So actually, I don't know if I have it logged in on this computer right now. Let me see, TradingView. I think I'd have to log in, but let me just see if I can just use it without logging in, so that way I don't have to pull in all the all my details. Okay. So yeah, so if you're going in on the fib levels here, okay, and we're trying to pull it in, you've got let's see, right here, fib retracements. So you could draw them out. It kind of makes them a little bit different here. So again, this one's not a perfect drawing there, but that's what you can do also with like any software program. It pretty much lets you do it. So here, take this fib level from the highs to the lows, and it'll give you an expansion range as well. Now this one, you'll go to the lows, and you can see, okay, where am I expanding to? So this is why for me, this one is not as clean cut, but you can see right there, there's the move to 61.8, and then it can keep moving down. So if you're like, let's say you want to play this to the long side, like you're going in, it's starting to move, and you want to buy, you can't see it, sorry guys. So let me move this chart over, sorry. So here, as I go in from the highs, and this stock's pulling down right here, it's starting to move, and I say, oh, I think it's a bounce. How far can it bounce? So you're trying to get in right here. Maybe a moving average is the one that triggers you, right? It's the trigger for you to get in. What you could do is, okay, I got in it, and now you'll let it ride, but how far can you ride? Well, probably 50%. Now in this one, you got a little lucky, 61.8, but let's just say 50%. You got into the 61.8, let's just say 61, and then you need to be taking some profits by then, and then you know that, hey, the bigger move is still to the downside. So I hope that makes sense. Is the same as percent sign and toss? Yeah, they're all the same. Like Fibonacci levels it's just a formula, right? So if we look at Fib formula, let's see if it's just like 0 plus 1 equals, Fib sequence. So if you want to look at the sequence, again, like mathematicians, people way smarter than me, they come up with all this crazy stuff. But what you do is you kind of add the number. Like say 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2 equals 5. Then you take the 5, 5 plus 3 equals 8. So that's what the Fib sequences are. So these are just percentage formulas that they use in trading. So this is where a lot of the moving averages come from. So 0, 1, 1, 2, then 3, 5, 8, 13, 21, 34. So if you look at the moving averages I have at the top, and when we start looking at things like this, these are all Fibonacci sequence numbers. There's a reason for that, right? So that's kind of what I'm doing, is using those numbers. Could you use like a 20? Yeah, if you use simple moving averages, you could use a 20. 20 because 20 trading days in a month. You could use a 50. Again, 100. Why do they use 100? It's specific because of the different amount of trading time frames. 200, same thing, because of institution levels and so on. So there's a reason for it, and that's why they use the common ones. I like the Fibonacci levels personally, but again, does it matter whether you use this ones or simple? No, it doesn't. Just find one that you like and stick with it. I changed it over the years. In the past, you might have seen my charts a little bit different. Over the years, I kind of switch it up a little bit, but what I do is, as I start getting into it, like I'll try one indicator, slowly start using it, like maybe I don't give it that much importance. And then I'll slowly like, hey, let me take a look at it. How does that indicator behave with what I'm doing? And then I don't really trade off of it. I'm just kind of browsing it. And then with time, I start, okay, I see how it works, how it's functioning, and how does it behave within my trades. And then with time, I might make it more important. That's kind of the way I look at it. Yeah, so many things to learn. I thought trading is easy. Yeah, it's probably the hardest job you'll ever have, if you have a job or call it a job. There is a lot of things to learn in trading, and it's a never-ending journey of learning. And I will say probably the most difficult part, it's not this indicator stuff. Like 90% of the stuff that's taught, including the stuff I teach, is a lot of the external stuff. And this is what I always tell people is like most people will, they want to learn like the outer game stuff. This is known as kind of the technical analysis. How do I do the spreads? How do I do the capital management? So this is all this outer game stuff. But the hardest part is probably the psychology or the inner game. It's kind of like the Michael Jordan or Wayne Gretzky concept. The outer game is actually having the skill, but the inner game is like when you miss the shot and then you're not like beating yourself up. This is probably way more difficult. Like this stuff, I will tell you, is the stuff that sells courses, money, education. It's what people want to learn. It's the same thing that I always say that guys, when they do dating courses, and the guys I've worked with in the marketing divisions, they want to go ahead and buy like things like pickup lines, when the reality, a lot of the stuff that actually makes you a good human being, nice, kind, is the inner game part that actually you need to work on. So anyways, remember that when you look at this, when you're learning this, it's, again, job-wise, when you're thinking about it, remember, this trading or investing is more along the lines of to grow your money, right? It's to grow or preserve the capital you already have. Remember that. It's very important. Whereas a lot of people think that this is all about making money. Yes, the titles of a lot of videos, you'll see it's about making money, but the reality is the core, deep inside, the core of it is about growing and preserving the money you've made. So whatever money you make in this basket, whether it be from a job, whether it be from selling ebooks, video courses, whether you were a nurse, electrician, plumber, doesn't matter. You're taking that money and you're putting it into this trading and investing bucket, and then you're trying to grow that money. Okay, so it's about growth of capital. It's not about income as much as what people like to think. And that's a very important distinction. So be very careful thinking that, you just give up your job real quick. It's much more difficult than you think for that, okay? For me, greed is getting me in trouble. I should learn to take profits on a small scale. Yeah, Ray. Usually if you got a trade, eventually you'll have a successful trade, right? Eventually, let's say you buy like 10 different stocks. Eventually one of them is going to work out, right? Just the natural statistics of probability. And if you're letting a good trade go against you and you had, let's say 100 shares, well, take off 20 shares and then learn, hey, what do I need to start working on and doing next? So sometimes it's like, hey, I got to get into a trade when you're getting in. If you're getting in too early, switch the trigger. If you're, taking a profitable trade, turning it into a loser, what's the trigger now that you can kind of reduce that problem? And that might be taking shares off. It might be going in smaller scale to be able to handle a pullback and that kind of thing. You gotta kind of work it a little bit, figure it out. It's like, okay, first step, what's my plan? What's my strategy? What's my trigger? And we could probably get a whole video and session about this. Then second thing, it might be, okay, after I do, let's say 20 of these, what did I learn? It's like, oh man, crap. Now I got to tweak it a little bit because I lost like, you know, let's say 12 out of 20, which you might not be happy with. Then what you do is, okay, adjust the plan a little bit. So where your entry's good, where your exit's good, were you able to hold the stock? Were you emotional? You know, you go through this like checklist, which is like basically planning out a business plan for that strategy. And you might have multiple strategies, as I talked about at the beginning. And then what you'll do is, okay, now let me go to round number 2. And then I do about 20 trades of those. And this is how I build on these strategies, is that then, okay, well, now maybe I'm 8 out of 20 trades. Okay, well, what did I do wrong? Or my entry's bad? You know, it's like, it's a never ending battle with it, to be honest. And now, like, by the time I get to like round number 4, what's going to happen is like the market conditions now are different. So now this strategy does not work, and I cannot use this for now till the market conditions change. So that's kind of like an interesting thing you go back to. You know, it's kind of like non-directional iron condors. I might not do those when the volatility is at 35 or 45. You know, you might be very careful, or you tweak them a little bit. But now you have a different type of iron condor in different environments. Okay, with options, I'm losing value quickly due to a choppy market. Yeah, what are you doing with options? Are you doing single options, Ray? What exactly are you doing when it comes to options? Give me some insight. But I'd say most people, 90% of the option traders or more, they're losing money because of theta, and they have negative theta because they trade options the wrong way. And we're going to do a lot more option live things on the other channel. This one I'm doing more technical analysis charts and just like actual stock related stuff, just looking at individual stocks, because it seems like people want that. So I'll just make some more content on that kind of thing. But a lot of people, they lose because of theta, or they're trading too big because they can't withstand the volatility. So those are a couple of the main issues when I do coaching sessions that most people run into. So be a little more careful with those issues. But again, just depends what you're doing. Okay, so we talked about Fibonacci levels. Is there anything else? I could probably look into one more, and then it will be time for me to kind of take a breather and break, because it is Friday. Calls. Okay, are you buying calls? Probably buying single calls. That would be usually the issue, is the theta. Because when you buy call, like let's say you buy like a 13-day, and it depends on duration. So if you have duration, like let's say here, buy a single, okay, and if you're doing out of the money, you got a lot of negative theta that starts to add up, especially if you're doing like more contracts. Like let's say you're doing 10, you're losing $140 a day. So as I look into people's accounts, meaning when I do coaching and consultations and mentoring, and we're starting to look and evaluate accounts, and they're like wondering why they lose money, a lot of times it's because of stuff like this, where the theta is just like nasty, and most people don't get it. I've talked about this actually in the rocket strategy on our latest live class that was like 2 months ago, where the theta is a big burn, but people get into this and they have a vega of 120 and they're buying a single call. But the issue is you got a positive vega, and when this goes up, remember, when stocks go up, the vega and volatility actually drops. So what ends up happening is on this upside, you're actually losing money because the volatility will, let's say, go down 5 points. So that line will drop. So you have to not only make up the theta, you have to make up the vega loss. So this stock really has to explode to make it work. I think that's the problem, Ray says, due to volume or volatility. I might be buying at the high vol. Yeah, that could also be the issue. You could negate the volatility if you're looking at that kind of thing by just doing a simple spread. And I will show you that real quick, since we don't have any other questions about technical analysis, is by just going in and doing like a spread, since we're doing Apple 175, 180, just buying a vertical, and I'm buying a vertical right at the money. And what you'll notice is I pretty much eliminate my theta, and my vega is almost neutral. So what you'll see is even if I go 185, just spread it out, one in the money, one out of the money, kind of right at the money. What you can do is spread those things out. And now look at your theta, it's practically nil, so I'm not worried about it. And my vega is practically nil. Now, once you get into this part, you will get thetas and vegas a little bit, but not as bad or nasty as you're buying singles. But this helps kind of eliminate the theta, vega, and it's done, right? You don't have to worry about it. You're just worried about price now. So that helps eliminate the option problems for a lot of people. I guess they're doing some updates on Thinkorswim. Here's delayed data and reconnecting and all that stuff. So anyway, thanks for joining me, guys. I hope that helps. If you have any suggestions for any future content topics you want to cover, I have some ideas myself personally, but if you have some that you'd like me to cover, let me know. I plan to do them more around 9:30. That seems to be the time that works for me. Afternoon, I tend to do a lot of my own trading and coaching and mentoring. So a lot of the afternoon stuff I work with, just my own personal stuff, accounts and all that stuff. But if you want to do some more stuff in the evening time, I'll probably be doing this at least for a couple months till after the new year. And we'll see how this goes. If the stream keeps growing and getting bigger, then we could keep doing this. If not, we'll see what happens after that. I'll have to make a decision. But anyway, if you have topics, specific things you'd want to cover, such as headlines, just let me know, write them in the chat, and I'll check them out and as suggestions, and maybe we'll cover them, whether it's on this channel for more charting related stuff or the other channel with options related stuff. And with options, I try to do things a little more simple for people. And I will always say YouTube for me on the option side, I try to keep it simple. When I get into courses, I will say my courses are advanced beginners or intermediate. Some people say they're super advanced, but I say from the general professional level, they're more intermediate or advanced beginner. And then when we get into coaching and mentoring or one-on-one sessions, I take it at your speed. Some people more advanced, way more advanced and experts. So everybody's at a different point. So yeah, thank you, William, for stopping by. You're welcome. It's a pleasure chatting with you guys. My one big thought, let me know if you would be interested in this, is to get people to hop in to do some quick Q&As, probably for like a 5 or 10 minute session. I'm still playing around with the software, but it'll kind of be like hop on screen and people ask some voice questions as well where we can interact, because I like that kind of stuff actually quite a lot. How do you sign up? I would say if you want to sign up to any of the courses, check out Rise to Learn. Like some of the courses are like 25, 35 hours long, depends on what you're looking for. The mailing list is really where you want to be, just to make sure you get notified. So check that out at Traders Fly. So here's some of the recent live classes. We did one on adjustments, portfolio construction, single options, and selling covered calls. So a lot of these classes are quite good. The adjustments one was really popular. It's, how many hours is it? Like 9 hours in just adjustments. And the Traders Fly stuff, just sign up for any of the freebies and you'll be on the newsletter list. And that way, as we release like new courses or like a live session, not every live session will be emailed because I don't want to bombard you guys, but just grab a freebie and then you'll be added to the newsletter list. But yeah, I try to do like classes and courses. It makes me think outside the box, and it keeps me sharp by doing classes and working with kind of the smart people. Because I find a lot of the people that do a class are usually the ones more dedicated, and that kind of keeps me in shape. It's kind of like working out at the gym type of thing. You want to, eat healthy, or you want to lift weights. The same thing here. Like you gotta work with people that are also willing to work with you and creative ideas and management ideas, and it makes me think. So that's kind of the way that I keep improving. Otherwise, it's kind of a lonely business, and that's why I also run a couple of other businesses and YouTube channel. Sometimes you got to separate the trading stuff and just do other stuff. So be careful remember what we said about the psychology part of it. Be careful not to get too tied into this, like watching the markets like 6.5 hours out of the day. If you're getting sucked into that, you're probably trading too big. If you're just worried about your trades, you're probably trading too big. The psychology is a huge part, and some of the things that take me away from that is actually working on the websites, the courses, the material, and some of the other business ventures that I have as well, because it allows my trades, it forces my trades to just kind of sit there, and I then kind of glue my hands, right? Duct tape my hands to my chair. And if I don't do that, if I find I'm watching the markets too much, sometimes I get out of the trade too early, or I get into too many trades. So by being on video or making videos, it was a good way for me to just keep my hands tied down. So find your excuse or way of doing it, whether you like to play chess or whatnot, doesn't matter. Pick something that works. All right, cool. So thank you so much for joining me. Been here for an hour and 20. Wow, much more than I thought. So thanks again. We'll try to pick this up again next week, maybe on a Tuesday, maybe on a Monday. We'll see. I've got a couple things I'm going to try to schedule out, and I will see you then next time. So thanks you again, everybody. Lots of love. Auf Wiedersehen. До свидания.